Good morning, everybody. Thank you very much for coming to the Accredited Conference in Dallas this year. We appreciate it. I know a lot of you traveled from far away, so we do appreciate you being with us today. I'm really excited about this panel. I've been speaking at the Accredited Conference for a few years now, but I think this is probably one of the best panels I've ever personally been on. I want to start by saying when I was asked to moderate a panel here, I wanted to put together a unique group that was similar in regards to they had the same goal, but how they got there was very different. So the point of this panel is to bring together three different organizations, all very successful in the multifamily industry, but with three different strategies. So I encourage everyone to, throughout the panel, feel free to ask the panelists questions. Feel free to grill them on certain things they may say. Each one of them is very knowledgeable and experienced and is more than happy to answer any questions we have. So let me start by introducing myself. My name is NoahMiller. I am the Vice President of Acquisitions and Finance at Pensam Residential. We're a multifaceted, multifamily owner-operator based out of South Florida. We are currently invested in about 30,000 apartment units through different programs, one being a direct equity platform where we own and operate, another being a preferred equity program, and another being a bridge loan program. We mostly invest in A, B, and C assets throughout the country. I'll let each panelist introduce themselves, but I'm going to ask that when you do introduce yourselves, there's three things that you mentioned. One is how long ago you started your own company. Two is over the last year, how many units you've either acquired, disposed of, or developed. And three, how that compared to the previous year. Let's keep strategy out of it for a second. Just let's talk about those three things. When you started your company, how many units you've how many units you've acquired, developed, or disposed of, and how that compared to the previous year. Ross?
Well, thank you, Noah, and thanks for all of you for attending. My name is Ross Odland. I'm the Executive Vice President of More Residential, and we are a relatively new startup company. We started a year ago, and More Residential really formed. There were four senior managers from Monogram Residential who got together and decided to really undertake the same strategy that we did at Monogram Residential. Monogram Residential was a publicly traded REIT that really came to be from the non-traded REIT days of Beringer Harvard, which once we fully internalized, turned into Monogram, and Monogram subsequently sold in 2017 to Greystar, one of their newly formed open-end funds. And so after that sale, four of us got together and decided to form More Residential, and More, the sort of the name behind More, is we like the name More Residential. We think that it sort of sounds cool. And More was our ticker symbol on the New York Stock Exchange. So currently, we're partnering with a group out of San Francisco who has sponsored platforms with managers in the past, and we have 4 assets, 3 developments and 1 acquisition, and we're going to use that as a seed portfolio, which we're going to hopefully then go out and partner with institutional capital in the Class A market. At Monogram and at More Residential, we focused on Class A assets in generally the coastal markets and the southern growth markets. So with that, I'll pass it out to Stewart.
Great, thank you, Ross. Thank you, Noah, for pulling us together. Thank you all for being here today. My name is Stewart Hsu. I am one of the 2 co-founders and president of the CONTI organization. We do value-add, multifamily, predominantly workforce housing. We'll talk a little bit about that as the session moves on. We started in 2008, so good time and bad time. We'll talk about that as well. But we've been around a little over 10 years. In that time frame right now, our current portfolio is around 7,800 units, to give you context for the next point I'm going to answer, which is we acquired last year just shy of 3,000 units. We dispose of about 350, and we develop 0. So we don't develop, we only do value add. So thank you, Stewart.
I'm Rich Fishman from the ValCap group. I started buying real estate, multifamily, in 1995 in the San Francisco Bay Area. got to about 2,000 apartments, and I created the ValCap group, which is more of a corporate structure for owning and operating real estate. The last 12 months, we bought a little over 2,000 apartments. We bought one A product that had some developer distress in Houston area. The rest were all value added, including some repositioning of old hotel that we are making into apartments.
Thank you, Richard. Perfect. So as you have an understanding, all these gentlemen have been in the industry for a long time, and now I want to take some time to focus on their specific strategy. So Ross, let's start with you. You've clearly been in the industry a long time with your background at Monogram. How did it make sense for someone to start an organization at this point in the cycle? I think a lot of people, look and say it's so hard to buy. For someone who left Monogram and started your own company today, tell us how that came about, why that makes sense, and what your strategy will be over the next 5-10 years.
Yeah, well, we, as I mentioned earlier, the strategy that we had at Monogram, essentially we think we can replicate that same strategy at more residential. And we're, there's no doubt about it. We've got a couple folks here who like the Class B value add space, and that certainly has been the product type du jour over the last 3 to 5 years as people try and seek additional yield. And we're a bit of a contrarian in that we actually like the A space. And our latest acquisition that we did, actually our only acquisition so far, has been in markets that are heavily supplied. And we think that we bought that project, now it was a little older being a 6-year-old property, but we bought that at a pretty hefty discount to replacement cost. Now, as we all know, construction costs have gone up dramatically over that 6-year period. So while we think it's a great asset in a great location, buying a good asset like that at a discount to replacement cost, we think makes sense. And we think that there's going to be a lot of opportunities like that in markets that have a lot of supply. There's no doubt that we're getting somewhat long in the tooth in this cycle, and we think that there are going to be some people that are going to be nervous and they want to get out, and we're happy to jump in and buy good product in good locations, understanding that for the next year or two, it's going to be brutal with respect to the competition. But we think that's a pretty good strategy moving forward. In addition, we also at Monogram, what we want to do at More is partner with developers and develop in certain markets that we think it makes sense as well.
The assets that you're buying in these core locations that are overbuilt, are you seeing any distress situations, or are these slow lease-ups? Are these properties that aren't getting performer rents? I mean, is there any type of clear discount from where the developer thought they were going to be?
Yeah, again, I think it's when you've got equity partners with the developers who are just getting nervous. They think, look, it's been 10 years, this cycle is just too long in the tooth. We think there's going to be a bit of a downturn. Those are the types of opportunities where, the newer product, we're not buying as much of a discount. But if we can buy at replacement cost or a little bit below replacement cost, and it's a good asset in a location that we like, we're long-term holders, and so we're happy to hold that for, our plan is 5 to 10 year holds at least. So there's somewhat of a distressed situation from that standpoint. And that, there's no doubt in Dallas, NOIs for the Class A space have gone down. Revenue has done fine, but when you start factoring in the real estate taxes, the assessors have gotten very aggressive. Your NOIs have gone down, and so we're buying a little bit on a concessed rent roll as well. And so, like I said, for the next couple of years it'll be tough, but long term, if you have good assets in good locations,
Yeah,
we're happy.
I agree with that strategy, and because these folks paid a lot of money, I think they deserve to hear what are those pockets that you can go in and buy today that are overbuilt for the long-term hold. So I think there are some long-term holders here who are willing to say, we don't need high cash flows today, we can go with low cash flow today, knowing we're going to hold on to it for 10 years. So what are the pockets you're targeting, and you think those opportunities exist?
Well, certainly downtown Dallas, the uptown market, there's anyone who's from here has seen all the cranes, so that's one market that we're looking at. Denver, lower downtown area in Denver, the low down district. Los Angeles certainly has a lot of supply. Portland has a lot of supply. Seattle also, those are markets that have a lot of supply, but long-term fundamentals, those are certainly markets that we think have outperformed in the past and will continue to outperform, but for a short period of time where there's going to be a lot of competition.
Sure, good. Okay, thank you, Ross. Richard, I know you mentioned that you bought one asset that was a little bit newer, but I don't believe that's your main strategy. Walk us through your strategy and how that's maybe differed from the strategy you've had over the last 5 or 10 years.
Well, we actually haven't changed our strategy at all. And we are looking for property where the rents are lower than the sister properties in the area. And so we basically look at an asset, what are the rents in the area, what does it take to get to those rents that are currently in the market. We don't project into the future. And if there's enough of a rent bump, then we'd like to buy it. It's very simple.
We've spoken in the past, and you've told me that cash flow is something you're interested in over the next couple of years, especially as it's getting harder to buy value add. What's your view on cash flowing deals versus value add deals?
Well, we're concerned that we're going to be stuck with real estate. I mean, everybody wants to buy today, but the spigot turns off in a second, and then all of a sudden nobody wants to buy. So having lived long enough to have been through that cycle, I want to be owning real estate that's already positioned and making cash flow. Usually, we basically push an asset up the hill, and the next guy says, oh, I can do the same thing more, and yes, we're going to make all that return, he'll make that return. But today I am concerned that there's not a next guy, and so I want to be there, refinance it, put good debt on it, and wait out a recession if there's a recession.
Got it. Stewart, I've known your organization for a long time, your partner as well, and I believe you're one of the best groups out there. And what I know about you guys is you love value-add deals. Historically loved it. Over the next year, 2 years, 3 years, are you still going after value-add deals?
Yeah, we are. So maybe get a little bit of context for what value add means for us. Maybe even, if I feel like, I can say why that's important to us. So any of those who kind of get to know me, I'm a huge fan of Warren Buffett, right? And so any of you kind of studied or read about Warren Buffett, he's got the 3 most important words of investing. I don't know if anyone knows, raise your hand if you do. The 3 most important words of investing are margin of safety. Margin of safety. It's a chapter in the book by his mentor, Benjamin Graham, who was a professor. The name of the book is called The Intelligent Investor. I highly recommend you guys read it if you get around to it. And so margin of safety is essentially the way we look at value add. Right? And so in today's market, it's really hard to get a major discount. Right? Maybe you can get something just below market, but it's a free market. We believe those forces work really well. That's what makes this country great. So if you're buying things at market price, then your margin of safety is your ability to create value. How are you going to add value to a given deal? And that really is the way that you ensure or try to maximize your chances of not losing money. Okay? Another Warren Buffett quote, 2 rules of investing. Rule number 1, don't lose money. Rule number 2, remember rule number 1. Okay. So it sounds simple. The guy's been around. He's got an incredible track record. Something to learn from, right? And so we're buying at market prices. The ability then is how do we create value in our deals, and that really becomes our margin of safety. And how you create value then is we think of it in sort of 3 main buckets. So one is exterior improvements. So this is not unlike other folks here on stage or
these are trade secrets.
These are not trade secrets. Yeah. So 3 buckets the way we think about it: exterior improvements. They could be rebranding, new signage, paint, roofs. look and feel, curb appeal, all the things you hear about. Interior improvement upgrades, so it could be backsplashes, new appliances, new flooring, paint, ceiling fixtures, water conservation, all the things that you heard about that are all good to do. That there could be operational improvements. So we believe that many times, not every time, but many times we can operate the property more efficiently, better than maybe the prior one. Okay, so for us, when you say value add, it's got to have some combination of those 2 or 3 areas that we feel like, kind of like Richard's thought process is, if we did these 2 or 3 things, we can bring the rents somewhere higher than where they are today, but it's already proven in that submarket. When we're doing underwriting, we don't want to do value add, but our value add assumption is that, oh, now we're going to be the highest rent ever in that submarket across those properties. That's not us. That's not a formula for value add. And so, as long as we believe that properties are aging and they go through different cycles, and Dallas-Fort Worth as a given market somewhere trades around 11 to 13% of its stock every year. So there's a fair amount that's really not moving hands year to year, and so things get older, managers may change, ownership may change, and so we sort of believe that, at least for Dallas-Fort Worth, there's a nice future of properties that will continue to have value opportunities.
Sure, I think a lot of people in the audience are looking to invest specifically in Dallas. In the Dallas portfolio that you bought over the last year, you mentioned 3,000 units, or even the assets you bought a couple of years ago. Is it as easy to really push the rents in these value-add deals as it was maybe 3 years ago or 4 years ago? What kind of rent growth are you seeing, and are you seeing any resistance from the tenants who are just saying, I can't do it, I just can't pay $100 more, or even $50 more?
Yeah, that's a great question. So from our perspective, what we're seeing in DFW, the answer, and I can dig into a little bit, but the answer is clearly, it's not as easy as it was 3 years ago, 4 years ago. Right? There was just a lot more factors that were allowing it to have the higher rent increases, and so the way we think about risk and trying to be more conservative is, one, focusing more on cash flow year one, right? So maybe there was a time 5 years ago where the IRR play was definitely attractive and maybe less risky, where you could say, hey, let's buy the deal, put in 10 grand a door, raise rents $125. That was more prevalent, I would say, 5+ years ago. In recent years, we've shifted more to what I would really call more light value add. How can we strategically add just enough value where we feel like it's already proven in a given submarket, a given area, that can then generate a $50 to $75 increase.
Right, and we'll get to it later on in the panel, but I do definitely want to talk about what you mentioned being operational value add, because I think that's important. But let's hold off on that for one moment. Stewart, to both you and Richard, not to Ross, because I know Ross's answer, which is obviously he's in the development world, so he obviously likes it. Is that a space that either of you have looked at getting involved in?
Well, Ross is in the development world, but I'm not. I've looked at it, I've poked at it. It's a whole different business. I'm not a contractor. I don't build things, and so I keep going back and forth. Do I want to spend the opportunity cost on learning something that I don't know? I probably could learn it. It might cost me $5 million to learn it. Is it worth that? And sometimes I say yes, it's worth knowing how to build things, how to make money doing that. There's some smart people doing that. And other times I say, well, I can make $5 million and just buy that C-class asset. So I keep going back to, well, it's too easy for me to make that $5 million without knowing more than I already know.
Mm-hmm. Stewart?
Yeah, on our side, we have bought deals in the past where one of the exits was tear down and redevelop ourselves. And we're always wondering, when's the right time to tear it down? And so now it doesn't feel like for us it's the right time to tear it down. But it is, I think we realize it almost fundamentally is a different business. And so while it's on the periphery of possibilities, it's not at the core. And so it continues to be something that we'll kind of push out and see if the stars align for it or not.
I'll add one more thing to the land play, because to buy land, you need cash. And usually I come out of deals 1031. It doesn't make sense to buy land from a 1031. I can't raise money from family and friends to buy land and sit there for 2 to 3 years. I've got to have institutional money. And there's a reason why institutions build, because they have a much longer horizon than we do. Stewart and I do, and they can afford to buy a nice piece of property, buy the Hudson Yards project. Mr. Ross can sit on that for 10 years, work his local magic, and then have a great return with MetLife. But I can't do that. I'm not able to.
Sure. Ross, I'm curious to get your viewpoint on whether or not a lot of groups who have historically been like Stewart and Richard have gotten into development, or at least if you've seen that as your competition grown from historically developers to groups who historically are just buyers who need to get into development because they need different yield.
Yeah, I mean, I think there are certainly, even some of the home builders have moved into apartment building, and as people try and seek additional yield, yes, development could be an avenue for them to go into, and these guys are exactly right. It's not easy, and our program, by the way, we're not one who takes a lot of entitlement risk and buys unentitled land and goes through the process, because that is hard. Our program, while we do like development, it generally is we create structures with development sponsors who are very good at it, and we partner with them with the intent that we want to buy the project once it's built and complete, hopefully on time and on budget. We like to try and structure it. If it's not on time and on budget, well, then it comes out of the developer's back end, assuming it's not a force majeure issue or something like that. But we do like the additional return you get with development. Now, we fully recognize not taking the entitlement risk, our returns will go down a little bit, but we think it's a good sort of risk-adjusted return working with the groups that really know how to do it. And with our shop, we've got a couple developers on staff who have the experience and capability to step in if something does go wrong, but we generally like to partner with the folks who they're going to get the project done, and so that's really our development program that we have.
Sure. Let's talk about the market in general terms when it looks back at other markets and other cycles. You've all been in the industry a long time, and history repeats itself. Everyone knows that. What you're seeing right now, over the last 5-6 years, does that remind you of any other point in your career? And if it does, how did that end up going?
Well, I guess Ross and I can talk more. But I remember I was a mortgage broker in the 1980s, and the RTC thing happened, and the savings and loan people might not realize it, but the whole banking industry collapsed almost in this country. And so there were tons of apartments for sale. People who had money gobbled them up at 20 cents, 30 cents a dollar. And that the apartment building business didn't really recuperate until around 97, 98. It went for a long time. And then it had, from 97 to 2007, had a 10-year thing going. And I actually have a different flavor for this thing. I think that it took all the way to 2014 to 15 to get over the Great Depression. I don't think we were in a recession. I think it was a real collapse. And so just to get back to the values that we had in 2006, 7, 8, 2014, 15, and then I think you've got another 7 years from there. So I actually think that we've got to 2022, 23 before this thing plays out.
Yeah, I would agree with everything that Richard said. I think the fundamentals are still very good for apartments with respect to the fact that we still are undersupplied in total housing units when you factor in the single-family homes that just haven't been built. On the apartment side, we're now getting to a point where we're building at a level that historically, a little bit above what we've built historically, but we're still combining single-family and apartments. We're still way undersupplied from that standpoint. And the fact that people just like the mobility and they like living in apartments in urban areas that is just more dynamic, and they like to live there for a longer period of time. So all of that, I think, is very good, and difference being, it doesn't seem as though the collapses that we've had that have been sort of real estate driven, and I think lenders have been, you know, pretty good, and we're not over leveraged like we were in the past where we ran into a lot of problems.
To answer your question directly, no, I haven't been in a part of the cycle where it felt like this. I think the thought that just goes through my mind is really, one, I totally agree on the fundamentals, that there's a shortage of supply of apartments, nationally speaking, and even in the workforce housing, so you can call it Bs and Cs, we really, as a country, panel, industry, haven't figured out how to really build new apartments at $900 rents, $1,000 rents. It just is a big problem that's just going to grow with time. So we believe that trend will continue. Hopefully we'll be able to figure out a solution together, but I think for now that is going to have a lot of demand in that space. But it's also the time for caution too. Right? So the economy is slowing down. I wouldn't say we're going to hit a recession this year, at least not from what we're seeing. But at least the data and the projections and the economists and the calls that we're on, it sounds like some slowdown 2022, 2023 could be on the horizon, but who really knows?
I would say my biggest metric of how we're doing is wage growth. And if the wages go up, rents will go up. If the wages don't go up, rents are stagnant, and you have to be careful. And I think we're just beginning to see some great wage growth amongst people who make between $12 and $25 an hour. I know we all hire people. We self-manage. Do you self-manage? And my maintenance guys, when the recession was 2010, they were making $14 to $18 an hour. Today they make an average between $17 and $30 an hour. Those are my tenants, and they're paying more rent themselves.
Got it. So it sounds like a lot of optimism cautiously moving forward. Richard and Stewart, both of you, it seems like had great years. Stewart, I think you said you bought 3,000 units, Richard 2,000. That seems like a lot of product to buy. How did you win that product? I'm out there every day looking for deals. I know that everyone in this room is, and it seems like it's just impossible to get those kind of numbers on the board in over the last 12 months. What was the secret? Did you pay a premium? Did you have did you know the seller? Were they off market? Give some insight.
Sure. Okay. Well, I have a reputation that I close every deal. So there have been deals where I kind of didn't want to close, but I just closed. Because I have a reputation that I have to close. You have to live with that. And so when I make an offer and I get to contract, I close the deal. I don't retrade very much. If there's a retrade, it's because there's a hole in the parking lot. You need to fix that or something like that. Something very obvious. The second thing is I often pay too much for the product. And over the years, I've looked back at what I bought, and did it ever matter that I paid 2 or 3% more than the next guy? It never mattered. It never mattered. And I look back and said, why would I lose a deal for 2% or 3% of the overall purchase price? So I just, okay, what is it going to take to win the deal? Here it is. If I want the deal, it must mean something. So, but I don't start out unless I think it's a home run. That's what I tell our team. If it's not a home run, let's not get into it. It might end up as a double, but I don't want to get into it. If it's a double, it might end up as a single or a loser. So I've got to really believe in something to begin with.
Two points to expand on. So one is going to sound cliche. Actually, they're both going to sound cliche. When you hear it, at least this is our truth, our experience, if you will. So one is credit to our team. We've been focused on really trying to build a healthy culture, a healthy organization. We try to find fantastic people that really love what they do, and when everyone leans in and plays hard together, then we get results like last year. And it wasn't just something like, hey, we woke up January 1st, 2008, how do we create a good team? It's been something that we've been thinking about and studying for 10 years, literally. Good to Great, fantastic book. there's a starter if you want, right? In terms of how do you really build a good team and a great company. So that's one. I want to really give credit to them. Second is also a cliche answer, but is relationships, right? And so we have, again, inspired by Warren Buffett, a really long-term mindset, right? So Warren said his favorite holding period is forever, right? It's like, what? You know, like in real estate, you got to get the deal, add the value, sell the deal. How does this work? Maybe real estate's different, right? But when you think about growing a company and what you're trying to do, and you think about really long-term, don't think in years, think in decades, then we think about, okay, what kind of company, what kind of culture, what kind of hiring process, what kind of people, what kind of systems, all of that starts to come into play, right? And so last year was sort of a culmination of seeing a lot of these things really fire on all cylinders. I would say our culture, which I'm probably even more proud about over the last year, has actually gotten stronger and healthier in 2018 than actually just the number and the size of our portfolio. So if you ask me what I'm more proud of, it's actually the latter, not that result. And so when you focus on people and win-win relationships, and you're talking to brokers, owners, lenders, and you're really trying to do things where it's not just about you, it's also about them, how do you make it win-win on both sides, then they're like, they want to do more business with you. Surprise, right? It's like, hey, treat others how you want to be treated. You close the deal. That one deal led to the broker saying, hey, they've got all these other properties. Would you want to sell it? Sure, let's take a look at it. Can we get to a price that we feel like is fair, that we feel like is market? We can? Great, let's close, let's get the deal done. So that was half the properties we bought last year, was just really because of that sort of long-term relationship, win-win, long-term mindset.
Stewart, I want to stay on you for a second. You're talking a lot about your culture, which I think is very important. I mean, as we live through this Silicon Valley, everything's culture. Let's talk about your management style a little bit. I know, and I've been on panels with Carlos, your partner, before, and he harps on how important it is to have great, not good, actually not even great, exceptional property management. Talk about your property management style, and if you've had to either adapt over the last couple of years to get more competitive, or if you've changed some of your property management strategy recently.
Yeah, I'm gonna think it and structure this quote. But the quote is, if you have mediocre strategy and outstanding operations, that will beat an outstanding strategy and mediocre operations. So that's the general concept. So strategy in the world is, okay, not a bad idea. Everyone's got tons of great ideas. It's really the execution. And so the operations part, the managers, the regionals, overseeing the managers, your maintenance staff, the leasing agents, really those are the folks that over time really win the day, if you will. And so, if anything, we've tried to do more, as our portfolio's grown, more events and more give back to that level of our staff to let them grow and let them foster more. But I would say at a high level, property operations for us has fundamentally been the same. It's been fundamentally the same. It's really about taking care of the tenants, all those small touches, making the lease experience as pleasant as possible, renewal experience, servicing work orders, being timely, courteous, professional.
Yeah, I'll let you talk a little bit about giving back to the community. I know it's something that CONTI has been involved with the last couple of years. Why don't you tell everyone how you guys are giving back to the community and what's that's meant for your company's success as well as the local community success?
Sure. Thank you for asking that. So the purpose of CONTI is to benefit the lives of everyone we touch. So we've got our team, our employees, our residents, our investors, and our partners, and also the communities that our properties are residing in. And so the more that we can benefit all of these groups as we do what we do, it just brings us joy. It's just as simple as that. So the community impact is something that has always been on the horizon, and just as you're building and growing a portfolio, there's only so many hours in the day. You have all these intentions, but you can't always do as much as you'd like to do. And so every year we just try to do a little bit more in terms of give back to the community. And so this past, even the past year or so, we started working closely with an organization called the Buckner Foundation. I'm not sure if you guys have heard of it, but they've been around. I think they were originally founded here in Dallas. They've been around over 100 years and they've done wonderful things. And so we bought a portfolio in the Bachman Lake area, and they have a new Hope Center they're building, which happens to be kind of smack dab in the middle of all of our properties that we've recently acquired. And so we wanted to partner with them a lot more to do ongoing education for the residents, for the community, classes like basic financial management, how you balance your checkbook, or maybe English, or maybe even like tutoring for kids and for schools. So happy to kind of get involved with them to help try to make the community overall rise and be a little better.
Richard, what about your management style? Is it very similar, or is the management more of we're here to keep heads
I
in
don't
the
know if I could follow Mother Teresa here. But our management style it's kind of interesting because it's evolved over time. And one of the things that we decided is that property management was like defense intelligence. It was an oxymoron, is that there is no property management. People buy property as investments, they kind of sidebar into, oh, this is a business, and then they start getting into it, they hire third-party managers, they try to avoid it. So in the last 3 or 4 years, I've decided that I can't avoid property management anymore. I did it, I subcontracted out sometimes. So we started the ValCap way. So everything that happens on a property, we have a procedure. We have a procedure for leasing, we have a procedure for marketing, we have a procedure for turning units. And if I'm sounding like I'm annoyed, I am incredibly annoyed. I hate it. But I bear down and I shed the light on every dark space in our operation, whether it's how the materials are stored, whether it's how you answer the phone, whether it's which units you turn next. And that's a very important thing, guys. You don't know which units to turn, and I do, based on what units are leasing. And that's a big deal, because that increased my occupancy by 2% across my whole platform. It wasn't in any algorithm. So we are very granular, we get more and more granular, and the people who manage for us, they have to do the ValCap way. If they say to me and our group, I know how to do this, I've been managing for 25 years, and they push back, they resist, they do their own thing, we terminate. We only want people to do the ValCap way. And the people who adopt it, they love it, and then they teach others, and then you have a culture. And that's what happened a lot in the last couple of years, and that's how we bought the 2,000 doors, is because this culture runs by itself. So I'm blown away when I hear people, oh, that's not the ValCap way. Wow, there's a ValCap way. We started something that has a life of its own, and that's a beautiful thing. And that could outlive me and the people who currently work at the company. So that's how we got from just buying real estate, pushing it up the hill, making some big returns, to today's work.
That's great, and I'm happy that you mentioned that there was a shift in your organization where you used to not focus on management, but today you're forced to.
Yeah, and I will add, I think, historically, Richard's right, it's been a necessary evil, kind of property management, and most people chose to sort of let a third party do that, but bringing it in-house at Monogram, as I said, we sort of are following the same model. We brought management in-house at Monogram 2 years in, and some of our best returns were on the property side once we brought management in-house. It's just having that control really does help, and certainly no disrespect. There are some fantastic third-party companies, of which I'm sure there's quite a few out here, that we've worked with, but just the culture and having that control just is where you get a little bit of extra help from there.
That's great. I appreciate everyone's input on that. I want to shift over to the capital stack just for a few minutes. Obviously, it's probably the most important aspect of any real estate deal. Ross, let's start with you. Because you're the only one doing development, give us an overview on what the construction lending world looks like today. Or are they getting aggressive? Are they pulling back, especially in markets that you're in where there's overbuilding and maybe occupancies are low? What have you seen?
Yeah, certainly there are some markets where groups have pulled back, but there is plenty of debt capital out there for developments. I will say, and all we typically do is we'll get a senior loan, and we don't go and try and find additional preferred equity or match financing on top of that. So we're happy having a construction loan at 60% of total cost. And frankly, we don't want to get higher than that. And what we've seen today, as compared to the past, is that construction lenders are there, but they aren't going to go as high on the capital stack. So they're really looking at potential coverage ratios once the property leases up. So if you're getting a senior construction loan up to 60%, it's certainly there. If you're trying to get 65, 70%, it's much harder to find groups that are willing to go that high on the capital stack. Now there's plenty of mezz financing groups that are out there that can help you enhance your returns if you so choose to get up to 80% in the capital stack. But that, as we all know, that can be a bit risky.
Sure. Richard, what has your take been on the capital stack recently? How have you structured your deals? Are you staying more conservative? Are you getting aggressive? Give us a little bit of insight.
I don't know how to be less aggressive. That's not my nature. So I basically push leverage to the max when I buy property. If I believe in my story, the value add, then I believe in high leverage. And then my goal is to get out of the high leverage debt as soon as possible. So I'll take 12 months, 18 months, whatever the make whole is on a loan, and I want to be there that day with a new loan because that is the highest return I can make.
Mm-hmm. And Stewart?
We're a little more conservative. We typically do 10-year fixed rate Fannie Mae debt. I think it's historically low interest rates, right? And so let's just remove the interest rate risk out of the equation altogether. Typically can get 4 or 5 years of IO, leverage in the 65, 70% range, so still reasonable from a long-term perspective. And so at least in our market, with the value at being our margin of safety again, we feel like there's a lot of room to grow from there.
Mm-hmm. Got it. Stewart, again, you talked a lot about your company as a whole, and you've grown it over the last 10 years to be a very successful company. Are there any concerns that you have at this point moving forward from a company standpoint?
From a company standpoint, sure. Probably, it's probably the hiring side, right? So we're at a very, very low point for unemployment. The war for talent is definitely there. We have a pretty rigorous hiring process where, on average, it's something like 150 applicants for each role filled. And so just sometimes we wrestle, is that too stringent? But on the other side, when it yields years like last year, we think, okay, maybe there's something to that. So the ability to kind of grow and attract quality talent is probably one of the top concerns for the company.
Yeah, I'd be interested again in Ross and Richard's point of view from a company standpoint. Any fears over the next couple of years or concerns?
My greatest fears, I'm 61 this year, and I want to find people to replace Rich Fishman, and that's a very difficult kind of decision. And, I would like to be drinking Mai Tais, on the beach myself. But I'm here, I'm happy.
I thought you were happy to be here.
I'm very happy.
I think there's always concern about we've had interest rates go down for the last 30 plus years, and is there going to be a point in time where that changes and the impact that would have on real estate and the run that we've had if for whatever reason, deficits or something out there that caused interest rates to suddenly go up 600, 700, 800 basis points. That's what impact would that have on real estate? Really, so that's a concern. But
Yeah,
that would be the biggest sort of concern.
Yeah, sticking to companies again, the reason I ask is because you're all founders of your respective companies, and I think that's something that's unique to this panel this year. And I think there are a lot of people out there who either have recently started their own company or are thinking about it. Maybe not this year, maybe in 5 or 10 years, but they want to do it at one point. What's some advice you'd give to someone who either wants to start a company, is thinking about starting a company, and advice on how to succeed, maybe what's a realistic detriment to their success, just anything, any insight you can give to them? This is an open question for anyone.
Yeah, it just depends on what kind of company they want to create. Are we talking about Ross? He's got an institutional quality company. His platform has the assumption that he knows people with millions of dollars that are going to basically be there to support the growth of this company and share in that. I came from the other part, which is entrepreneurial bent, and so that's a whole different kind of advice to that kind of person. My main thought is that if you are going to get into this business, that be prepared for the first 2 to 5 years not to make any money, just to really have enough money on the side that you can live without having to draw anything. It takes a while. There's a huge barrier to entry in our business today, and you have to be prepared for that.
I would add, find something that you enjoy or even love that is adding value in the marketplace. So if you can find something that you really enjoy or even love, it's even better, that's adding value in the marketplace. That'll help carry you through the tough times when persistence is really the only differentiator. Right? It's really persistence counts for so much in starting any new endeavors. And so it's sort of, I don't know, to get Mother Teresa philosophical.
You can't help yourself.
Yeah, help myself. But when the challenges come, it's really the test of how much are you willing to stand behind it, see it through, get creative, be resourceful, find that connection, go to that additional networking meeting when maybe you didn't really want to. That's when the magic happens. So
I'm going to add one more thing, which is you're going to have investors. Everyone does. Tell the truth. If the deal isn't going well, tell people right away, I'm having trouble with this deal. The numbers aren't coming out right. Let me tell you what my thoughts are. What are your thoughts? Be upfront, be transparent, be accountable.
Yeah, I would agree with that. I mean, we are in a relationship-driven business, and establishing those relationships through honesty and transparency and sharing the facts as they are, even if some of them aren't very good, that's going to pay dividends in the long run. So that certainly is the key, and there are going to be times when things don't look good, and so drawing on some of the relationships that you've built over the years can certainly help you get through that.
Anyone like to ask a question? Any gentlemen? Sure.
We've kind of skirted around all the 10-year due notes that we have. Some are 5, 6 years old, some are still new. What happens in 6 years from now when we find ourselves at 12%? That's the game. There is nothing else. It's 12, 13%. And we have to refinance all this stuff at 12 and 13%. Is there anything we do now, or
Okay, who's brave enough to take that question?
we just give up all our cash flow?
No. I would answer the question. If you really believe that that's a probability, that's more than a slim possibility, then you should hedge and buy hedge insurance, because you'll then be ready to offset that change in interest rates.
Yeah, I mean, if you certainly believe you're going to have an increase in rates like that, in addition to hedging, I mean, you just need to hold off, and it is something that we look at, but I don't see anything on the horizon that's going to cause an increase to that magnitude. There certainly could be something, obviously a black swan event that we don't know of, it could be out there. In that scenario, then you start buying at that time. because obviously the pricing probably would be more favorable relative to today.
HUD has 35-year mortgages. There's HUD guys outside. They'll be glad to refinance you today.
You want to add to it? I was going to say the same thing that Ross just said, which was if that does happen, that would be a great buying opportunity. Yeah.
Any other questions? Sure.
Richard, you mentioned you didn't know who was going to take you out of your deals. Can you talk a little bit about the last couple that you sold in Houston and what the buyer profile looked like?
Well, we've been selling mostly in San Antonio. We had 7 deals in San Antonio. Now we're down to 3 deals in San Antonio. They're basically people like Stewart who are buying. You know, they think I've left, and I have left. You know, meat on the bone. I always leave. There's always another guy. And I also sell, sometimes I sell too fast. I believe that you can never lose money by turning a profit, so I often sell maybe prematurely. I like making 50% returns, and I don't necessarily think about 300% returns. We bought a property in Houston in 2012 for $15 a door, sold it 18 months later for $40 a door, and I meet the guy who I sold it to all the time. Thanks for selling me that deal. And he's, you know, at 75 a door or 80 a door today. That's life. I mean, it's, you know, we're all in the same space. We buy from each other, and we all try to move the money around.
Yes.
No, including you, in this environment, you guys see maybe to compete or find deals, lowering your minimum unit size or going into markets that you may have not considered in the past, secondary markets, or, you know, obviously you hadn't had a hard time, Stewart or Richard finding deals last year, but going forward, might that change what you look for?
Sure. Last year was a hard year for us, even though the numbers sound good. To caveat that, there were 4 properties actually were contracted in 2017, so it was a rollover into 2018. But we are losing at a percentage rate more than ever before, right? So cap rates coming down, getting very competitive, more folks coming in from out of state. We're losing more than ever before in our company history. This year, if we do half the volume, we'll consider it a good year, right? From our perspective. To answer the first part of your question, are we looking at deals smaller? It's funny you mentioned that we actually revised our acquisition criteria just a couple months ago, where we looked at deals around 150 units on the low end, and we bumped it up because we felt like it was not as operationally efficient. So we actually increased the unit count versus decreased it. Having said that, we'll talk to Richard about what he's got in San Antonio. And so we're looking at stuff a little bit outside, so we're trying to assess and try to think when's the right time to look in other Texas markets. We're pro Texas Triangle markets.
So have your return expectations come down for B product? I mean, given the pricing, or are you still think
over what time frame?
Well, relative to say 2 years ago, or a year ago.
Yeah, maybe slightly. Yeah, I mean, from 3 years ago, 4 years ago, return expectations absolutely have come down. Maybe they've come down a little bit over the last year or 2 years.
They have for us, certainly. I mean, we recognize, look, it's harder to buy, and you have to face reality. The returns aren't going to be as good as they've been the last 10 years.
We've always bought property in tertiary markets, and we have owned property all throughout the United States at times. So we recently bought a couple of deals in South Carolina, Greenville, outside Hilton Head. We bought a deal in Columbus, Ohio, which I think is a major market. We own property in Appalachia, in Kingsport, Tennessee, and I love the people there. They're great, a great team there. We have made offers recently outside Kansas City. We're here to make money, and wherever the deal is, I just don't want to. I lived in California for 30 years. I don't want to go back there because I don't believe in competing with California money. It's too stupid. I can't understand what. I'm from there, and I just couldn't, compete with people who think a ValCap is a great deal. bring that mentality everywhere. So, but I love tertiary markets. I think that's the future of America, small cities. Doesn't everyone want to live in a nice, clean, small city with low crime, great schools, and all that?
Sure, so it seems
They'll
like,
buy a house though, that's the problem.
Well, they rent it. They start, they get older and they come back and their kids move out.
it seems like the consensus to your question is you have to adapt to the market you're in. And that means that you change your philosophy a little bit and get a little more nimble and creative, and you do it. I mean, at Pensam, we've done it. We never bought anything under 300 units last year. We bought a 150 unit deal. The economies of scale aren't as good, but it happened to be close by another asset we owned, and it ended up working out. Same thing with tertiary markets. We've entered a lot of tertiary markets we never thought we'd go into. One of them was Wichita. Wichita was never on our radar to buy in, but someone came to us with a deal, and we ended up loving it, and it ended up being a home run for us. So I think if you are closed-minded and say that you can only buy this in this location, you're only allowing yourself to see so many deals. When you open up your horizon and kind of cut down that box, you really see what's out there. Any other questions from the audience? Sure.
Yeah, I'm reading a book now by a guy named Joel Kotkin, who's a demographer, and he has a book called The Next 100 Million. He claims that the U.S. population will be 100 million more in the year 2050 than it is now. So where do you guys think those 100 million people are going to live?
Well, I would say obviously in urban centers primarily.
I agree with that 100%. They're going to live in urban areas.
How about some city names?
City names. I mean, they're going to live in all the Texas cities for sure. They're going to live, more and more. You're going to have more and more megalopolises. Like Phoenix is going to become just a 10 million population city. Other places like, Las Vegas is going to keep growing like crazy. Seattle, Portland, there's just a lot of.
Yeah, I mean, the California markets are burdened by how expensive it is to live there, which is good if you have apartments, but at the same time, the tech-oriented jobs are there, and while some of them are going to potentially move a bit, and we're starting to see it in Austin. Austin's a city that the tech companies are certainly going to, but
Florida is explosive.
Yeah.
If you want to see growth, go to Orlando. I don't know why people want to live in Orlando, but that thing is going to double or triple in the next 20 years.
We're obviously biased towards Texas. If you pull up the U.S. Census Bureau, they've got population forecast you can look up through years 2040, 2050. Texas is by far the #1 state in the United States to grow from a population perspective. If you pull up data from Texas A&M Research Center, the Texas Triangle, right? So Houston, Dallas, San Antonio, Austin. That triangle accounts for 80% of all growth in Texas. So there's your map. Right? Texas is #1. The triangle is by far #1. If you're playing within there, that's a good bet. A lot's going to filter into that area.
Yeah, just to that question quickly, there's a book that Bill Gates recommended. It was on his list of the top 5 books to read last year. It's called Factfulness. And it almost refutes that claim of population growth in America and says the opposite, which is we've gotten to the point where we're going to start to flatten. And a lot of that's because millennials aren't having as many children. The average household used to be 6 in the United States, now it's 4. And if that continues, then we're not going to have as much population growth. I don't know which is true, but just an opposite viewpoint. I think we have time for one last question. I saw one other hand go up. Go ahead.
Can you speak to return expectations?
Gentlemen?
Sure. For unlevered Class A assets in the coastal markets, it's essentially around a 7% return IRRs. What we're looking at. Developments, unlevered returns in the 10 to 11% range. Again, that's for Class A assets.
Yeah, for the value add deals that we do, which is predominantly Class B and Class C in Dallas-Fort Worth, we're looking at overall investment returns levered in the low to mid-teens. So we still feel like that's achievable, doable, not much different view from other players. That's where we're at. We look for a strong cash-on-cash component where we can get to 7% cash-on-cash as soon as humanly possible.
We're looking to hit home runs. We're trying to get into deals where we can hit a 30% return, but that's based on only holding a deal for 3 years. So that's the key, is high leverage, short-term holds. If we have to hold 5 years, we're looking at about an 18 to 22%.
Guys, thank you so much for being here. This was really one of the best panels I've ever been a part of.